If investing is science, he is Galileo Galilei. If it's an art, he's Van Gogh. If it's something in between, he has a right mix of the most crucial fundamental aspects of both. And so they say, there are investors, and then there is Warren Buffett. And as is the fate of all great art, is there a way, as Steve Jobs put it,
good artists copy, great artists steal. We have, always been shameless about stealing great ideas.
to become, if not great, then at least a good artist by copying what Buffett and his long-term business partner Charlie Munger have been doing successfully for decades? Well, there is. In this video, we will reveal the secret sauce, the secret mantra to become a value investor just like Buffett. In Berkshire Hathway's annual shareholder letter published last weekend, Buffett said, investments in businesses with both long-lasting favorable economic characteristics and trustworthy managers is key to making great returns. But is that all? Of course not. So let us unpack Warren Buffett's strategy for you. His approach is known as value investing. It is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value, and to hang on to a top-performing stock rather than trade stocks based on short-term price fluctuations. But picking a stock is easier said than done. How does one find such a stock? What should be the criteria? Munger outlined 4 rules aside from Buffett's number 1 rule: don't lose money. The first rule on that list is, do you understand the business? Apart from the obvious things, what you should try to ascertain about a business is, where is it going to be in 10 years? In Buffett's words, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And that means if you can't figure out the future of the company, it is better to let stocks you don't understand remain unpicked, despite the hype around them. That's what Buffett himself did in the 2000s. As he did not understand Google and Amazon in terms of their long-term profitability, he stayed away. Rule number 2. Does the business have a sustainable competitive advantage? According to Buffett, the most important factor in picking a successful business investment is the company's competitive advantage, its moat. The more secure the competitive advantage, the more likely the company will prosper over decades.
Price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price.
Rule number 3. Does the business management have integrity and talent? Buffett looks for 3 things in a manager or leader: intelligence, initiative, and integrity. But integrity matters most of all. To quote him from his 1998 speech, because if you're going to get someone without integrity, you want them lazy and dumb. He further added that we do not wish to join with managers who lack admirable qualities, no matter how attractive the prospects of their business. And now the 4th and the last rule on the list. Does the price make sense? As passive investors, Buffett and Munger seek out companies that seem to be trading for less than their intrinsic value, and believe, quote, it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Let us know if you think these rules can help you become a better investor. Please don't forget to like and share this video and to subscribe to The Mint.